Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. With the Fed's efforts to cool the economy and combat inflation, many project a growing prospect of a recession. So with these conditions, we thought we would explore what it might mean to the economy and the overall financial markets. So here to help me is Chartered Financial Analyst and member of our investment committee, Jerry Herman. So thanks for coming back, Jerry.
Good to see you.
So what do you think is going on with the economy?
Well, the focus is really on the Fed, right? They're trying to reduce inflation, which was recently at 4-decade highs. They're trying to cool the economy and navigate what's called a soft landing. And to do that, they're raising rates to curb demand and inflation.
And they've already raised rates 4 times this year, and there's more to come, aren't there?
That's right. You think about it, a pilot trying to make a soft landing. He has to be very soft on the throttle so as to not create a stall. If they do too much, they could actually stall the economic engine and tip the economy into recession.
So what are really the chances that they pull this off?
Well, it's not easy, right? If you look at a study out of the University of Chicago since World War II, 2/3 of the recessions have actually been caused by the Fed moving more quickly than the economy can handle. And Alan Blinder, the former vice chairman of the Fed, recently cited that there's been 11 periods of rate increases since 1965, and only one of those did the perfect soft landing actually occur. In 6 other instances, however, the impact on the economy was negligible, limited decline in GDP and rise in unemployment.
Yeah, and right now the economy seems pretty strong. Employers have added 2.7 million jobs so far this year, and unemployment is around 3.5%, which points to an economy far from a recession. So you think one might still be coming around the corner?
Well, by one definition, we're already in one. That's 2 consecutive quarters of GDP contraction. But we're not officially in a recession until the National Bureau of Economic Research actually declares one after analyzing a slug of data, and that usually occurs after the fact. But in a recent survey of chief financial officers, 68% actually indicated they expect one in the first half of next year.
Yeah, so we're talking about the economy, but we should remind investors that the economy is not the financial markets and that the markets really tend to be forward-looking.
That's right. The market does decline around a recession, but if you look at information provided by Y charts and analyze it, in the 10 recessions that have occurred since 1957, the median decline from the peak of the market was about 28%. In the actual recession itself, the decline was 4%, and by the time the economy hit its trough, stocks had already recovered 28%. A year later, they were up 24% after the recession ended.
So there is hope, and thanks for coming on the show, Jerry. So waiting for the economy to bottom has historically not been the best course. During June, the market was down about 20% from its peak throughout this year, but in July, the market is a large positive move of about 9.2%. So our advice is to avoid a knee-jerk reaction and to do your planning now. If you want to know if your portfolio is prepared for a possible recession, give us a call. Here's Fox News Sunday.